So, attention, please. Thank you. Welcome to April's Finance and Committee agenda, everybody. Mike can hear us online there. Yes, and we are live streaming, I believe. Yep, all good. So let's kick off. We have no apologies, which is awesome. So we'll move on to disclosure of members' interests. There being none, we'll move to late items. And there being none, we'll go to confirmation of order of meeting. No need to change. Thanks, Lou. Lou has moved and Bruce has seconded. All in favour? Aye. Contrary, no. It's carried. Okay. Confirmation of minutes from March's meeting on pages 8. 9, 10, 11, and well, 11. So happy to move. Thanks, Claire. And a seconder. Thank you, Roger. All in favour? Contrary, no. It's carried. We move to financial report. Ken. Nada.
Oh, well, more properly than
Nada and Yolanda. Welcome.
Good afternoon. I'll just take the report as mainly read and I'll just point out the financial results for March. So the total income is currently at 72% and the expenditure is at 80%. The development and reserve contributions are at 3 million, which is 24% of the forecast. Subsidies and grants are now at 67%. Then the capital, we're looking at 82.9 million to date, which is 52% of the forecast. And I'll just take any questions.
Yeah, Claire.
Yeah, thanks a lot. I'm looking at the table about the significant activities, which has got the operating revenue and the operating expenditure. That's on page 2 of your report. Because I see that transportation is at 97% already. Yeah. And I'm just wondering, is that signalling that we're actually going to be struggling to stay within budget for that particular activity? Like, I know that like stormwater is over, but it's the quantum of it, it's quite minor, whereas transportation is quite significant.
Yeah, that could be some timing, but I would need to go and have a look and get back to you.
Yeah, thanks.
Okay, Dawn, no, do you have no insights on that? No, okay, thanks. Yep, Mike.
Thanks. Just got a couple of questions on the key risk indicator report. Thanks for that. We didn't get this in the 8-month report, but it was in audit and risk in March, I think. So just noticing a few changes there. There's quite a lot of red showing up. Just wanted to ask you about 2 of the changes, just to get your perspective. So the key risk indicators there, a couple have gone from green to red in those 2 months. The first one I don't actually even understand. The annual plan 70% growth. What does that mean and why has it gone from green to red?
So that is the expenditure on our growth projects to date. So it's currently only sitting at 38%. So the red is just indicating that that's a risk to meet the target.
Cool. So
and
capital,
a lot of our growth has been pushed out. So
okay. So it's just CapEx.
Yeah.
Growth capital. Okay, cool. And the other one was, oh, it's the same. CapEx 80% LOS. Is that level of service? Or what?
Yeah.
Okay. So how's that different to the first one?
Ken.
Yeah. So look, if I may, so probably the better reference point is the 3 speed dials in the middle of the right hand side. So those are our 3 forms of CapEx, if you like. So growth related. So we're installing infrastructure to meet growth and development demands. The renewals is just obviously renewing, replacing what we've currently got on the ground, and then the LOS, the levels of service, what that is about is actually making service level improvements. So putting in infrastructure that better services the existing community. So those are the three forms of it. That's where so in relation to growth, what we're saying is that we target to achieve 70% of that. That's very variable according to demand pressure. The levels of service, we even accommodate a lesser delivery there of 80% because that's not so vital. But with the renewals, obviously what we're all about is maintaining our infrastructure in good working order. So we target for that to be 100%. I guess in relation to the three speed dials, what we're currently saying at this point, 3/4 of the way through the year, is that we are anticipating that our renewals will hit that 100%. We've got that as green. The other two we're thinking they will fall short of the 70% and the 80%.
Thank you. Can I still have a follow-up question, please?
Sure.
On the renewals, in the annual report, by activity groups, you can see the CapEx that is renewal CapEx. Okay. By activity group, it's all there.
Okay.
But I couldn't find it anywhere where it was added up to be the data underlying the speed dial. There is the statutory measure of CapEx against depreciation.
Correct.
But when you're growing like we are, that becomes a meaningless metric because you really want to know renewals against depreciation. And this speed dial is telling me that, but I couldn't find that in the annual report. Is it somewhere, or is it we just getting that now because it's in the key risk indicator report, which I fully support, by the way.
Look, I don't necessarily, unless Ivanada or Yolanda could assist with that. I'm not sure it would. I mean, I'm not sure it is particularly identifiable in the cost of service statements, is it, in the significant activities area? No.
I would like it if it could be. And reporting it like this is great because I think it's a really great thing to know. Because when you're growing as fast as we are, that statutory measure is just meaningless because I don't know how much of it. You can't make an assessment whether the renewals are proceeding at an appropriate pace from what's reported publicly.
Yeah.
Unless I'm missing it.
No, that's a really good point. And like you say, these speed dials do bring that out. In the past, I've sort of tried to get into the numbers that are reported. It's very difficult. But I think we can rely on the accuracy of what we are getting here. Which is good. And the growth one, of course, sorry, Ken, but the growth one really relates to, it's a reason why the DCs are so low as well. They're linked.
So through the chair, so Councillor, are you saying you would like to see these at a lower level? Like, are you wanting to see like the renewal by activity area, like by water, wastewater?
No, we do see that, but it's never summed anywhere just to see that it's broadly the same. So, look, reluctant to use the Fonterra example, but they always report to us compulsory CapEx and which is renewal CapEx and voluntary CapEx. And it's just a nice thing to know. So you can see when the when they're trying to reduce their CapEx budget, where it's coming from, just as a check that the renewals aren't being sort of sacrificed as time goes by. And I think you're seeing evidence of that in other councils elsewhere, where some of the infrastructure is getting pretty creaky because they've been mining their renewals budget, I suspect. Over time.
So through the chair, then, just to clarify, so assumably the three speed dials that you're seeing in this report are helpful for what you're asking.
Very helpful. They're brilliant.
Yes,
So thanks.
Helpful. Okay, great.
Claire.
Yeah, could I just clarify some things with some of the comments that Mike made? Like, firstly, that it's difficult to gauge our performance because we're growing so quickly on whether or not our depreciation numbers reflect, what the assets we're actually managing. Because my understanding is that it would, because we don't depreciate until the following year that we bring on the assets onto our books. And so, in fact, the rate of growth that we currently experienced, it doesn't really affect the reporting. I'd just like to clarify that. And the other point was to have separate reporting under each activity, but in fact, we do have it as a percentage of the budget, and that in itself would indicate whether or not, you know, we're sort of towing the line with making sure that we're keeping up with the depreciation that generally have been planned. Yeah, so just to clarify those two things.
Yeah, so look, actually, I think in terms of the seeing it by activity area, in terms of how we're going against budget, I think actually your best example of that is on page 22. So where we do in every financial report, to page 22 of the agenda, we do the statement of capital expenditure that shows for each activity where we're at against original budget and against forecasts, etc. So that so that covers off on that one. Sorry, your point. Sorry, what would you just return to your first point again? Just refresh me again.
No, that the fact that because we're growing rapidly,
Yes.
yeah, the depreciation renewals that we're reporting on probably doesn't reflect. Yeah.
Yes.
And I'm thinking perhaps it probably is okay.
Yeah, so look, through the chair, actually, I took it, Councillor Mike, that that you were referring to the Department of Internal Affairs prudent financial measure. So there's about 10 of those. They're reported right at the front of every annual report. And look, one of those DIA financial prudence measures, as Councillor Mike said, compares the amount of capital expenditure in the infrastructure area to the depreciation, and obviously aiming to spend more on capital expenditure than what the level of depreciation funding is, because that would show that you're maintaining your infrastructure. Now at Waipa, we always we're embarrassingly high on that particular measure, and I agree with Mike. It reflects our circumstances as a growth council, because we're because it's picking up the growth and the level of service expenditure as well as the renewals. But we are forced to report against that measure. It's like those are benchmarked measures that every council in the country needs to report against exactly, and it does pick up on all capital expenditure of whatever nature and compares it to depreciation. But for us, like we're sort of miles above it every year. We sort of hit that measure out the back, because it doesn't sort of reflect that we do have a huge amount of growth related expenditure as well as the renewals, and I guess through the chair, that's the importance of perhaps of those three speed dials, so that we can see that we are actually renewing appropriately in terms of having a target of meeting that renewal capex to the 100% level.
Councillor Pettit, sorry, Mike, go ahead.
Yeah, sure. I'll just bring back this. Thank you through the chair. Just one's a request. Just on the first page, the very first line, in fact, under total income is currently 72%, etc. Is there any chance, Yolanda or Nada, that we could just have in there, we are 75% through the financial year? Next month, it might say we're 83% through the financial year. Just that big overarching figure, I guess. That's a request. The next one is actually on page 5, and it's just some clarifications really. If I start at the bottom there with that graph, that rates rebate graph, and there's about $70,000 there, difference between last year and this year, of what we've subsidised. Have we factored that into, did we factor that fairly accurately into our annual budget, is my first question.
That's funded by central government.
Oh, it is. All right. Sorry. Thank you for that. Thanks for that clarification. It doesn't affect us then. And then my next one is just a bit of an update on just the arrears, the total amount owing sort of for normal rates or water rates, and just where we feel we're at. I've got the figures there, but where we feel we're at in terms of getting that money back and how much of it we may miss out on.
Yeah, I think we're in great shape. That's a really good. We've virtually halved the total owing from current years, which so our overdues are really low. I doubt there's another council in the country that's got these numbers.
Yeah.
Ken, would you?
Yeah, so look, I would say the the best to look at page 23 of the agenda for that one. So in terms of general rates, so that you can see that our arrears, so these are rates that are older than the prior year or older. So only $77,000 worth. At this time last year, that was $95,000 worth, and in fact, our recovery during the year has been 86% versus 78% the previous year. So look, those are incredibly low numbers and quite a small cohort of ratepayers who owe us that money. In fact, if I walked through to the rates department after this meeting and said, tell me who owes that 77,000, they'd probably be able to quote me the list. It's a very, very small list. But yeah, look, as the chair has also pointed out, if you glance down a little bit further down the page, and you can see total owing from the current year that's been billed and still owing, only 237,000 there. So that is very encouraging. Yes, there is still one further instalment to bill. Appreciate that the fourth instalment is not showing in these numbers. But look, that's I'm pretty confident that it'll be a relatively low number. That's going into the arrears next year to match what's already a very low number. So we're doing very, very well in terms of the rates collection front. The next page, page 24, you see a very similar thing in terms of water rates. Actually, the format of this report is a little bit different, but look, you can see that we've got 90% collection in regard to the water rate. So look, we do have very, very good collection rates here at Waipa.
Thank you, Kent. Thank you for that.
Okay, no further questions? Bruce, yes.
On page 6 of your report of 19 on our one, the blue one, and dividends on, it's a comprehensive income. Is that the airport money? Then maybe it's a bit more. Is it just the airport? 83,000? Majority of it, yeah. No, that's good. Thank you.
Who through the chair will be hearing from in the next item.
Okay,
in fact, we can ask for a larger dividend. Entirely up to you.
Not sure why I'm laughing. That's a real good idea. So if there's no further questions, I'll move to the recommendation on page 14 that we accept this report. Do I have a mover, please? Thanks, Mike and Marcus. All in favour? Contrary, no. It's carried. Thank you. Okay. Moving to item 7, council controlled organisations, and I think our first is going to be who's on screen, I believe.
Yeah.
So yes,
just briefly.
Yolanda, please introduce. Thank you.
Good afternoon, committee. So this is the report for our council control organisations, reporting on their 6 months results up until December 2022, as well as their draft SOIs for 23-24. So we will have each of the CCOs presenting to you on their results and their CCO. And after the presentations, if we could just reflect on the letters that our feedback letters to each of them, I would appreciate that.
Thanks, Yolanda, and thanks for your work on these summaries as well. It's really good. So now we'll go to Andrew. Welcome.
Good afternoon, councillors. Thanks for the opportunity to talk to you. I won't talk for too long. I'll just give you a very brief overview on LGFA and the draft SOI, and then welcome any questions that you have. So I'll just share my screen here. Right. So just the first page, quickly overviewing the developments of LGFA. Last year, we had a record amount of lending to councils at 3.3 billion. And for the 10 months to April 23, we're already up to 3.4 billion. So we continue to be quite successful in providing finance to the sector at a time when there's certainly a lot of capital expenditure occurring. In terms of our membership, we now have 77 out of the 78 councils. The only council we don't have is Chatham Islands. And we also have 3 CCOs that have joined, and we now do direct lending to. Sort of ironically, we actually set up the ability to lend to CCOs with Waikato Water when that was a concept in mind, because we thought that was the way that the sector could sort of potentially go, and we wanted to be able to finance those entities on behalf of the sector. The other important thing is we sort of maintain our AAA credit rating from Standard & Poor's, which is important to us, and that enables LGFA to get cheap financing for the sector. Just in terms of the structure for LGFA, just to give you a bit of an overview. So we have our board, which has 5 independent members on, 1 member from the sector, Alan Adcock from Whangarei. We have the Shareholders Council out to the left, which represents the shareholders and guarantors. And there you can see our staff. So we sort of have 10 staff. A couple of those are part-time sort of resources. So we're quite small relative to an $18 billion balance sheet. In terms of the profitability, in recent years, we've been making around sort of $10 million a year in operating gain. It's important to point out that maximising the profit is not LGFA's primary objective. So yes, we want to make a profit to strengthen the balance sheet, but to the extent that our profits grow, rather than keep growing the profits, we'll pass on any savings back to councils through lower borrowing margins. Our profit is likely to be lower in 2023. The main change in the business has been LGFA holding a much bigger portfolio of liquid financial assets. So historically, we used to hold around $400 million of liquid assets. Because of what I touched on, the amount of record lending, because of the volatility that we're seeing over the past few years in global financial markets, we now hold between $2 and $2.5 billion of liquid assets. That does come at a cost, but the primary objective for LGFA is just to ensure that we can keep providing financing for councils, even if there are sort of major elements of volatility in financial markets. And we've seen it again already this year, where we had a number of banks, Credit Suisse being the largest bank, that pretty much collapsed and had to be taken over. And that caused a lot of dislocation in global financial markets, made it very hard for corporates to issue debt. Onto our performance targets. These are the targets for the 6 months to December 22. We only didn't meet one. Probably on this page, the one we're most proud of around is we have a target of having 85% satisfaction score when we survey our council members each year. We do an annual survey. So for the year to June 22, we had 100% satisfaction rates from council. So hopefully that gives an indication that we're doing well in terms of our primary objective of getting finance to councils in a timely manner when they need it. The one objective we didn't meet was our reductions target, our carbon reduction sort of plan. We have a carbon reduction target by 2030 to reduce our emissions, and we're currently net zero in terms of our emissions. What we didn't have is a plan how we intend to reduce our gross emissions year by year out to 2030. So we just had a board meeting this morning, and that is currently being progressed, and we should have that actual year by year target in place. But our objective to reduce our emissions by 2030 hasn't sort of changed. In terms of the new targets, the SOI really hasn't changed significantly. So I will just touch on the financials, but in terms of our specific targets, the only two things that are really sort of changing is the one around assisting the sector with the transition on Three Waters. As it is to the whole council sector, that whole uncertainty about what the model's going to be, the timing of it, creates a lot of problems, both for us in terms of forecasting our finances, but it also creates a lot of challenges around knowing what the plan is to transition the debt. We have been working very closely with the NTU and DIA. However, we still don't have a specific plan, and nor do we know exactly what LGFA's role will be in the financing, and whether we're potentially going to be involved in the financing of the water entities. And to complicate things even further, of course, we have the election, and that causes the same challenges to us as it does to you in terms of your forward planning, when we still don't have exact certainty about what the structure is going to be. The other thing we've done a lot more work in is on climate change and adaptation. In this month, we just issued our first sustainable bond to the market. So that was a $1.1 billion issue. It was very successful. We brought in a number of new international investors that hadn't bought LGFA bonds before. We now have 5 councils who have done sustainable project loans to. We've done 3 climate action. We have 3 climate action loans to councils, and we hope to bring on a number of new councils in the next sort of 12 months to add to that. But it's fair to say the majority of councils don't have carbon emissions plans that would enable us to lend climate action loans to them. But we see our role very much as assisting the sector and moving in the right direction on that. In terms of the actual finances, again, as I touched on, it's very hard projecting the profitability when we don't exactly know the shape of what our model will be, subject to what Three Waters will be. But we're aiming to for the profit to be sort of up around sort of $8 to $10 million over the next 3 years, which we think's a good level. So happy to stop there and take any questions.
Thanks for that, Andrew. Yeah, very interesting and quite comprehensive as well, which is.
Yeah, thanks. Claire St. Pierre, I'm really interested in sustainable funding frameworks and climate action loans. I just wondered, is there any difference in the discount that you give for sustainable funding bonds or the climate action loans? Is it the same, 50 basis points, or is there other incentives for councils in taking out these loans?
Yep, that's a good question. On the individual project loans, we give a 5 basis point discount. So keep in mind our base lending margin to councils is only 20 basis points. Oh. So compared to banks, if they're taking 200 or 300 point margin when they're lending to a client, a lot of the margin that we're giving is a bit symbolic, just to represent that we are giving something back to incentivize councils to to do that. On the climate action loans, it's a 2 basis point discount, but that 2 basis points applies to all your borrowings from sort of GFA, whereas the project loans just provides as a discount on the financing to that one project. Our sustainability committee, we have 4 independent members on the sustainability committee, so they're definitely pushing for us to increase the margins in the future, and I suspect we will do that as profitability grows. But I would sort of point out things like Wellington, they have, it's quite a green leaning council, so a lot of the benefits, are not just the saving that you make, but the wider mileage the council gets from demonstrating to the community that is doing things in that sustainable and climate sort of related space.
Thanks for those comments. I was wondering whether or not there's the potential for you to work with central government to maybe set up like other government-based incentives that would be paired with the interest or basis point discounts that you can give, whether it's, for councils, it might not be just tax breaks, but other ways that perhaps central government could also provide incentives. It'd sort of be a partnership with the LGFA that might make it even more attractive to councils to try and get on board with these projects. I know, like overseas, there's other incentives like financing incentives or tax breaks and things like that, and it'd be ideal for LGFA to be working with the government to achieve those.
We're definitely speaking to the government, and one thing that is coming is reporting sort of requirements for the whole sector. So all finance institutions, including LGFA, are going to have to report on the emissions, on their level 1 and level 2 sort of emissions. So that is something from 2024 onwards that LGFA is going to have to get emissions from the council sector. Not all councils will be able to do that, but over time, that is something that the government is imposing on the sector. I do hear what you're saying about additional incentives. I think one of the big incentives is simply that financing will be harder to get on a global basis if companies do not sort of participate in the space, simply because so many institutional investors are asking more questions, looking at where the proceeds of their money is sort of going. So simply one of the big benefits is by participating in the space, you're demonstrating to the wider investor base that you are taking climate action and sustainability seriously. But I hear what you're saying, and we do have dialogue with DIA and other sort of council related organisations, and so we'll certainly ask questions along the lines of what you've asked.
Yeah, thanks, Andrew. And I do know that investors, they are often willing to accept a lower rate of return because it's going towards climate action. So it's something that LGFA doesn't necessarily have to wear, the full cost themselves, but investors would also be willing to do that. I just have one follow-up question, that's to do with Three Waters reform. Whether or not LGFA have considered revenue bonds, because that was something that the Castalia reports when they were earlier involved with the process. They said that they'd had potentials to benefit councils. Have you looked into revenue bonds?
We've looked at a few different sort of forms of sort of financing, different sort of structures, including special purpose sort of vehicles. We know there's been talk about sort of infrastructure bonds. It's questionable whether anything along those lines would still end up being cheaper than what a AAA rated entity like LGFA can raise just by issuing debt normally. But, you know, I mean, we'd sort of look at anything with regard to the Three Waters. As I touched on, we still don't know exactly what LGFA's role will be. If it involves lending to the water entities, that's not something we can do without coming back to our council members and getting them to change the terms of the multi-issuer deed. So that is something we'd have to engage with the wider sector on, and it's for the sector to decide, you know, which sort of model is the sort of optimal one for it.
I'm just really pleased that you're working in this space, actually. I think that the message you're giving us today is that LGFA is wanting to be proactive and sort of assisting councils wherever they can. I mean, for councils, the benefit for revenue bonds is not simply the interest rate, but the fact that it isn't sort of included in their debt profile for their credit rating and things like that. So it allows them to actually sustain a larger portfolio of borrowing than the caps and limits might otherwise allow. But thank you very much.
Yeah.
I'm sorry, I had so many questions.
I'd just add, you know, the whole models keep sort of changing, and now we've potentially got 10 water entities versus sort of 4. So the whole models for each of those entities and how much they're going to need to borrow and how much leverage they have all sort of changes again. So until we actually see what the numbers are, what leverage is required, it's only then you can start determining the optimal financing mix for those entities.
Thank you.
Yeah, okay. Anyone else? No? Yeah, so thanks, Andrew, for joining us, and congratulations. From where I'm sitting, LGFA has been a really great success, so keep up the good work.
Okay, thanks very much for your time.
Yes. Okay, Kelvin, welcome.
Afternoon, everyone. So look, thank you firstly for the opportunity to come and chat to you. Thank you. I'm conscious that some of you won't have actually heard me speak before, and for those of you that have, it was over 12 months ago, so it's possibly a timely reminder to talk a little bit in the first instance what we're about and why we CoLab exists, and also the governance structure and how we organise ourselves. I want to briefly talk about how we work with YPAR and the councils more generally, and then appreciating that you've seen the half-yearly report and the statement of intent included in the pack, just touch briefly on those two documents. So our vision, as noted on there, is for councils to maximise the value they provide to their communities, and it's quite deliberately about you. It's not about us, because you're a business owner and you're also our customer. We aim to realise this vision by identifying and realising shared opportunities, and we do that in 3 ways. Firstly, we work with councils to investigate and develop opportunities that we collectively believe will add value. And in that respect, we're a bit of an ideas laboratory or your R&D resource. Secondly, we provide shared services to councils. And thirdly, we enter into joint procurement arrangements as a head contractor, which are for the benefit of multiple councils. In terms of our structure, we are obviously a CCO. We're owned by 12 councils, predominantly in the Waikato, although Western Bay of Plenty came on as a shareholder of CoLab last year. The board is made up of 6 directors. We have an independent chair, Peter Stubbs, and 5 council representative directors who are chief executives of the councils. And for Waipa, that representative is currently Gavin Iron at Waikato District Council. Beyond the governance of our, beyond the board, sorry, the governance of our services typically comes in the form of advisory groups, and those advisory groups are generally made up of council general managers. And their purpose obviously is to act as a sounding board for our workstream manager that sits within the company and help inform the direction of travel to make sure that the services that we're providing are ones that you want to receive and are providing value to you. And then on the opportunity side, the governance of opportunities just follows normal practice with a project steering group. For our signature projects, which I'll talk about shortly, those are projects where we devote resource from CoLab to progress those opportunities. We will generally seek to have a council chief executive as the project sponsor for that project. So in terms of the services we provide to councils, it's fair to say that they are many and varied. They've typically come from investigating opportunities in the past. So our services include supporting the building consenting authorities within councils and providing quality assurance through the Waikato Building Consent Group. Our most significant unit, if you like, is CoLab Water Services, which undertakes water sampling and analysis, trade waste management services for councils, as well as Smart Water Services, which is about educating your community on how to conserve water. We provide procurement support to some of the smaller councils, and our procurement team work with your procurement manager and others from other councils on cross-council procurement opportunities, as well as managing those joint contracts. Rata is responsible for working with council staff to look at best practice around asset management and infrastructure assets. And through the Energy and Carbon Management Program, we support councils by monitoring energy use and looking at opportunities to save those and reduce carbon emissions. Needless to say, we're not shy about taking on anything as long as the councils are willing to or wish us to do so, and it makes sense to do that on a shared basis. With an eye to the future, we've got some key topics or opportunities at various stages of development. These are described in the SOI, and I'll talk about those shortly in detail. I just wanted to flick back to the last, the 6-monthly report to 31 December. I mean, it was certainly a busy time for CoLab. I mean, we're obviously a small company. But some of the key highlights, we supported the councils hosting a shared induction event at FMG Stadium for new councillors, given it was a new triennium. We spent time working with the council chief executives to, I guess, put forward ideas for future investigation that could create value and get feedback on those to come up with a regional lens on what the priorities of those opportunities were. And we obviously progressed a number of opportunities that are already in train, most notably our customer digital enablement project and Shifting Landscapes, which is essentially the banner that initiatives that we work with councils on to support them through the various central government reforms. That Shifting Landscapes is the banner that we put those initiatives under, and Gary Dyatt is the sponsor of that particular program of work. In terms of looking forward, obviously the SOI, as you've read it, sets out a number of priority projects. I guess the first two up there, Right People, Right Place, and People Post 3 Waters, is very much about at different levels looking at how we might overcome capacity constraints within councils across the region. So how do we position or make sure that we don't leak human resource as a result of the waters reforms more than necessary, and right people, right place is about how do we look to grow the pipeline of people that are interested in getting into the local government sector in the future, and having that interest come from people that are going to have the right skill sets that councils are going to need in the future, not necessarily right now. I'm happy to talk about any of the other opportunities on there, but I will say that at the bottom of that is low-hanging fruit, and is noted in the SOI. And increasingly, when I first started, we were very focused on, I guess, more transformational or larger initiatives that we felt could add real value. We recognise now that we've got to find a balance, and that balance is between those sorts of projects and projects which are low-hanging fruit in the sense that they don't have a massive change impact for councils, but they save you immediate money. And I'm hearing that back from chief executives, and so that's certainly something that at the upcoming board strategy day we'll be thinking about in more detail, because we've got to get that balance right between immediate cost savings and what I would regard as potentially more transformational projects. And we also have to get better at communicating our value. So I acknowledge that we prepare documentation and we do communicate to the council executives on value. So we've got an annual summation of the value that we provide to each council that sits beyond the statement of intent, and that's available in a portal that's shut down, so it's specific to each council. But it's fair to say that the process that we've gone through to date in terms of being able to quantify benefits that we provide, while the quantification is robust on what we've done, there's a lot more to do in that area. And so we have an internal project underway in the first half of this year to work out how we get better at measuring that those benefits and communicating them to you. I'm going to stop there and happy to take any questions.
Okay, any questions? Claire?
Yeah, thanks. I think that CoLab presents great value potential, for councils. So I'm really keen to see CoLab operating, in that space you're talking about where you're able to demonstrate the value and things like that. And so I'm really keen to hear about that work that you're doing to work out how you can measure the benefits and things like that. I mean, I would have wondered whether or not that could be part of the project design of how, and to maybe have an estimate to start off with then and see whether or not those estimates pan out or something. But I guess it's difficult to measure some of that stuff. If you any sort of concrete examples of what low-hanging fruit might take the form of or anything?
Yeah, so we're grappling with this at the moment. In fact, I got told by a CE of another council the other day that this is what we should be doing, coincidentally aligned with my thinking anyway. But I feel like there must be an opportunity for us to collectively essentially data mine council operating expenditure, look at categories of spend and where there's alignment of that spend across councils with particular contractors or in particular areas, and having regard to that, work out what the appropriate response is that, and it could be one of two things in very broad terms. It could be entering into a bulk purchasing arrangement like with multiple councils, as we've done in other areas. I mean, the most The most compelling of those is the insurance arrangements, which
Mm.
provide a huge premium saving to councils each year, right?
Yeah.
So how can we apply that logic to other areas? And look, I'm speculating here, but the other obvious opportunity that might drop out of that is recognising that councils are spending an awful lot of money with external contractors in a particular area, and is there opportunity to bring some of that in-house on a regional basis, albeit it might not make sense with one council, right?
Yeah.
And a good example of that is in the building consenting space. We know from work that we've already done, it's probably a couple of years old now, that across the Waikato councils are spending about $2 million a year on outsourcing processing of building consents. Is that the smartest way to do that, right? Or is there another way to cut the cake?
Oh, yeah.
So that's our early stage thinking at the moment. The report that I mentioned earlier that we send out to each of the councils. So obviously the SOI is across all councils, right? It's a report to our shareholders collectively, but we are in the process at the moment. I'm pretty sure we've sent the Waipa one of sending out to individual councils what their investment into the company is, whether that's for paying for services or the development of opportunities and other initiatives. We haven't updated the value document yet, but we will do that on the back of the final SOI. So that will be in about July or August of this year. And as I say, it's available to councils in a lockdown area of our website. I should also note that the SOI, of course, is out of date already. As my predecessor there said, because of waters reform.
All right. Yeah.
So we made an assumption which departed from the position we took last year in the SOI, but we made an assumption that Colab Waters, which is our single biggest unit, as I mentioned earlier, would no longer be around from the 1st of July 2024. And of course, that date is now unclear. So there's no doubt that the draft SOI will be updated to reflect whatever the latest lie of the land is closer to the 30th of June.
Oh, thanks for that. Could I just clarify, you mentioned about the insurance work that was done. So that was under the Colab sort of banner.
Yep.
Yeah. Because, you know, I would have thought that would certainly warrant reporting on, because that's a great success story, actually. Yeah.
So the trick is what is the SOI, what should the SOI be presenting as opposed to other documents, right? And I guess, we do try and highlight quantifiable benefits where we can in the SOI, but it's more about reporting on the measures that we think are required in order to deliver benefit to councils, right? So we know, we've obviously got a measure in there around that we will develop business cases that show, if implemented, that at least $300,000 of savings to councils are going to result. We know that if we do all of those performance measures, we will be creating value and councils will be receiving benefit. It's just a question of whether we should be reflecting that benefit directly in the statement of intent or focusing on those performance measures, and then separately reporting to the individual councils what the individual council has received, because not all councils take up all services, right? So it would be a bit of a misnomer to consolidate it, I guess. I don't know.
Okay, thank you.
Yeah, and doing a separate SOI for each council would be, I don't think you want to go there.
Yeah, so look, the investment document, which has already been sent to councils, that's quite detailed. That runs to 8 pages, and I suspect Ken gets blurry eyes reading it. But the point is that we want to be really transparent with that, right? But the values document, which is very high level summary, it's only 2 pages. And that's structured in a deliberate way that if councils wish to do so, they can share it with their councillors. Because that's, I think, all you'd want to see, quite frankly.
Okay, no, thanks for that. Any further questions? No, so yeah, look, Live Perceptions Collabs added a lot of value to this council, and we look forward to continuing to do so. But like Claire, I'm very keen to see, measuring those benefits is the best way we can. Yeah, so thank you very much.
No, you're very welcome. Thank you.
joining us, and all the best. Okay, so Mark and Scott, please join us. Another busy year, past and forward.
Another busy year, Chair. Good afternoon, Council. Mayor Susan. So look, if you're happy, I will get straight into it. Conscious of your time, how are we going?
Yeah, no, we're doing all right.
Okay,
Yep.
all right. So look, what we'll do is obviously give you the usual update that we provide in respect of the airport group. I've also just put a couple of slides in on our recent decision we've taken around our designation, which we discussed with the shareholders a week or so ago. I'll take you through a couple of the slides that give a bit of a rationale. I'm not going to give you the 20 slides that supported the designation discussion, but enough that you'll have information. So, very briefly, we did have a strong half year. You will have had our results. And look, Scott will go into that in a wee bit more detail in a moment. But suffice to say, two aspects, or three aspects really, some strong one-off gains that assisted the P&L, and also the underlying performance still continues ahead of forecast and ahead of budget. So all in all, a good year, and we are seeing a recovery of passenger volumes. We would expect by the time we complete this financial year that we're literally back to pre-COVID levels. And those of you that travel will probably see that not only out of our port, but out of any of the ports. In addition, the hotel has recovered strongly. So we were always concerned how that would go as we came out of the MIQ facility and back to a trading hotel. We had a conservative budget, but it significantly exceeded the budget and is trading extremely well. And then the other point, the diversification strategy that we've often spoken to you about now, we're sort of probably 5 years into the into our 10-year strategic plan. And again, I just want to reiterate to you that that has paid, I was about to say paid dividends, but it paid a modest dividend to you, but it has paid dividends in respect of our performance. As you know, we went through COVID with record profitability, and that has continued out the other side. So certainly without that strategy, we would have been quite a forlorn airport with a hotel that could well have been empty for a couple of years. However, what I would say, we've still got challenges ahead of us in this economic environment we're in. It's difficult to read. It's difficult to see the impact on passenger volumes going forward, and for argument's sake, on the hotel. Fortunately, we're at a phase where we have sold the vast majority of property that we intend to sell over the next 2 or 3 years. Some of it doesn't settle for another year or so, but we've actually made those sales. So we hit that cycle very well in terms of the property cycle, but there's no question we'll be impacted by some view of the economic cycles ahead of us. So I'll get Scott now just to go through the financials for you.
Good afternoon, everyone. Well, look, I'll save you some reading, and basically the takeaway on screen is it's a range of short-term metrics and a range of long-term metrics, and they're all being met, which really all around healthy financial position, financial performance. There, you'll see we did have a large profit at half year and to a degree forecast through to the full year. We had one-off land sale gain. We had a significant amount of property settled. It was at the contract at the height of the property boom. We're largely now sold out, as Mark just mentioned, so we can see very modest land sales come through over the next couple of years. We also had a couple of one-off gains rising to property we've acquired. So we made the strategic acquisition of the former L3 flight school. So we own the land. Buildings were owned by the former flight school operator who's left the New Zealand market to able to wrestle control of those facilities, and a former in New Zealand engineering facility as well. They were quite off market with some lease exit, and for various accounting reasons, we get to revalue those immediately through profit and loss. So that's distorted the gain. Those were the gains that will happen at the first half of the year. There are some losses. Generally, I think we're all aware of what's happening in the commercial property space. We obviously have a large property holding, so there's some risk there. Equally, we've got a number of legacy obligations around water assets and roading upgrades that we're starting to work through, and actually some of those will vest to Waipā. So there are some losses to come in the second half of the year, or sort of not so much losses, but one-off costs as well to be booked. But we've gone through some unforeseen challenges. We didn't foresee a pandemic a few years ago. We didn't foresee a seismic challenge on a fairly new terminal building, but we've been able to survive a pandemic, keep investing, we've diversified, and we've got more or less the same debt we went into COVID with. Also not on screen, but non-financial metrics. This year, for the first time, we introduced some climate change response measures. Went for energy and emissions reduction. We're on track to achieve both those, and certainly around energy reduction. I think it comes up a little bit later. We're actually in the process of installing the solar farm. So we'll see some pretty aggressive reductions in those over the next couple of years. Just moving, looking at our past performance, and I appreciate some of you have seen this before, so I won't dwell on this slide. We historically started the last decade behind break even. The core business core business earnings weren't enough to sustain the basics like depreciation and interest. Kind of we were getting there about pandemic time, but 2022 is quite significant. 2022 financial year, of course, we saw initially the Delta variant, which country had a full lockdown for about a month. Then we saw Omicron hitting that financial year. We had very little land sales in 2022. So that blue line, which is break even, if you take the land sales away and the MIQ hotel benefit we had, that's almost everything above the blue line. So we had an airport ravished by a pandemic, and it still was able to return a small profit in its own right. So that's probably the best story of what the last decade looks like, is we're able to get hit by COVID and everything else, and actually stand on our own 2 feet. Next slide, just I think the dark green on the left just shows the impact of land sale activity on the current year trading. So next year we take away a lot of land sales, and we're fortunate that the remaining, what's left on the pie chart gets a little bit bigger. So all the other core business areas, aeronautical business, the hotel, all those key areas, core areas of the business that happen year on year are scheduled to grow and are continuing to perform well. Just looking at our future earnings, so sort of that first half of the graph is the recent few years. It's really, again, it talks to our 10-year strategy and our growth aspirations going forward. You'll notice 2023 looked a little bit different on a couple of graphs ago, and I've taken out the effect of land sales. That's because looking ahead, we don't have really much land to sell. So you can see there that lighter blue, that recurring property income that gets really steady going forward. There's modest hotel earnings. In fact, the hotel is really trading really well due to events in the Waipā, particularly major sporting events. We've got obviously Velodrome and Kirapira. So really it's a Waipā hotel more than shall we say, a Southern Hamilton City hotel. And then the dark blue piece, which is what we are an airport after all, and that's actually the biggest growth piece through the 10-year model. It's obviously we've made it a little bit easier on ourselves, saying it's going to be a big growth piece with starting at the lows of COVID, but over the 10-year life of the model, that was our biggest growth piece. And you can see sort of pre-pandemic, this first couple of years where it was trading. Go to our next slide. And this is quite a busy slide, but if I just direct your attention to the right-hand side, that graph and the green dotted line is actually our airport. And above it are some of the other airports and how they've traded over the past couple of years, certainly since we've emerged from the Delta lockdown where everybody was at zero. And it's really just reassuring us and giving you some comfort that as Air New Zealand face crewing and aircraft constraints, that as a region, we're being fairly treated compared to other airports. You actually see at times we've had more growth than most other regions. And just in the past couple of weeks, we've been able to secure about an additional 6% capacity out of Air New Zealand looking out through the next through the winter, through the end of September, which is quite significant. Again, they continue to have aircraft, not so much shortages, but they're constrained more by crewing as well. So look, we do sit below other airports in terms of total passenger volume. That is simply because we don't have direct flights to Auckland. If you look at some of those other cities, of course, flying to Auckland is really a necessity given the distance to drive. But yeah, I think on the whole, we're at key points in that journey. We've outperformed some of the other regional airports. I'll hand you back to Mark.
Thanks, Scott. So look, I just thought I'd briefly touch on our Northern Precinct, our plan change. Very conscious that you're the regulatory authority in relation to the plan change, so I'm talking to you very much as a shareholder in this slide. We had our hearing last month, and the commissioners have just recently closed off the hearing process, and we expect a decision over the next couple of months. And really, that's to, as you would, those of you that perhaps are not as close to our private plan change, PC20, you can see the Northern Farm, Northern Precinct, which is the strong bolded black line that is to the just below the mauve purple area. And then you'll see a smaller section of land as I'm looking at the screen to the bottom left there. So that's our farm is 100 hectares, and the other 30 hectares is the Yates family. So that provides 130 hectares roughly that is in the plan change application. The point of this slide is just to demonstrate that we've also, because we thought you'd like it, we've bought you some land. So the yellow block of land that leads from Rains Road down to the river is an 11 hectare block of land that we went unconditional on at the end of last month, and we settled 30 June. That's part of the decision we made with our technical advisors, particularly Tonkin Taylor, with providing for solutions around the bat habitat and challenges that we might receive through the plan change process. You can see the red dotted circles imposed on those maps. They're actually known bat habitats. And if you look at it looks like a green hockey stick, that will be a bat corridor we will create on Northern Precinct. So the bats and the big blob of green is what will be a 5 to 10 hectare, which is where our retail hub will be, but will also provide about 5 hectares within there as bat habitat. So the intention here is that the bats can migrate through Northern Precinct. They and the purple highlighted land is actually Crown land that's already acquired for Southern Links. So that is the interpretation being that we can provide a way of supporting those bat habitat areas down to the river, and you can see at the top of the map the red dotted lines, which are of course around the Waikato River in respect of bat habitat. So that's where we're at. So we await the decision, and of course, as you would then know, there is a period where whether there may be an appeal of the plan change, and then we ultimately hopefully towards 2025, we'll be considering some form of initial development on the land. So that's well in hand, been a big piece of work for the last particularly 2.5 years. I think I was very pleased with the way the hearing went and the way our consultants and experts were able to support us. So that's the Northern Precinct. Very briefly now, I just want to take you through, this is the decision we've made. Those of you that have been involved with RAL for a number of years will be aware that we had we have a number of designations at the airport that support various aspects of the aeronautical business, noise boundaries, obstacle limitations, surface boundaries, etc. And as well, we had a runway extension designation that allowed us to extend the runway. The decision that we've made over the past, certainly started back in 2016 when we had to make a decision around approach lighting designation, which was on Meridian 37's land to the north of the airport. We let that designation lapse, had a shorter designation than the 15-year designation on the main runway extension. That designation period runs through to 2026, and we needed to make a decision really as to the requirement or the need for that designation. And the decision has been made, which we took the board through over the past 12 months, and then, as I say, took I took the CE, the shareholding CEs through this, and then the mayors last week or so, 2 weeks ago. But the reality is we do not need the extension. So the current runway and would, depending on aircraft, may require some strengthening, but the current runway can service us right through the South Pacific, right through Australia, and in fact up as far as places like Singapore, depending on maybe on some minimum restrictions on weight. But the reality is our current runway is longer than Wellington, that served up to Australia and Singapore flights, and our research was wide-ranging. It covered also the profile of visitors to New Zealand, both inbound and outbound, our own market, and there is just simply no demand. There has been no demand, and we see no demand for direct services, as an example, from much wider areas such as take a Singapore or Dubai, maybe a Dubai or further into Asia, as being a requirement that there is simply not a market for it. So we feel that, and then there's the small piece that we have to give effect to the designation. So it meant that we couldn't continue to kick, if you like, the can down the road. We needed to make a decision as to whether or not we were truly going to extend the runway, and the extension of the runway and all of the resulting infrastructure you would need to support an extended runway would have been somewhere in the order of 100 million. And there was no business case to support that, and certainly no airlines are going to pay the requisite servicing of that debt. So we think we've made a very sound, very sensible decision, well supported by RMA lawyers, by by planners, and by Airbus, who are the preeminent global experts on aviation, who also reported and provided a report to us. Our planners and Airbus were both around in 2009 when the designation was first put in place, and that was more about land protection. There was no business case back in 2009 to extend the runway. It was a land protection strategy, and so we feel that's the position that we're in. It's the right decision. Our new master plan that this map represents looks out through to 2052, as you can see, and we think we've protected your asset, but made a sensible, pragmatic decision around the designation so that we can move on and work with the existing infrastructure.
There's a couple of slides that we covered in discussion. So just to pick up on back to the aeronautical business. So flight training, we see still a growth opportunity. So of course we did have the CTC, the L3 Harris Flight School, provided service 300 international students that all lived in the region for up to 2 years and employed over 100 people. So part of that for us to buy that facility was to really control the narrative around bringing an operator back into the region. We've had, of course, some interest last year, some of you involved with a very credible international operation. Look, it's probably realistically a slow burn, but really good price if we can get there over the next couple of years. Look at private jets. So during COVID, some of us had used our overseas holiday funds to upgrade the kitchen or buy a new car. Some people decided they were going to buy corporate jets. And that market, I think, is increasingly viewing us as a credible alternative to Auckland. We've really seen that as the borders have opened, we've been able to bring some high net worth visitors to the region, just with Auckland having competing priorities around airline development, and of course now talking about terminal expansion as well. So we're seeing huge opportunity in that space. We've also sold some land to private investors who are doing developments next to the airport. And it's now up to just coordinating their developments with our own taxiway infrastructure. And then general aviation generally, so general aviation, everything that is in airlines, remains without the flight school. We were nervous what that could flow onto engineering businesses and the like. We're still seeing a lot of growth with the aeromedical space, with Waikato Hospital being, of course, a tertiary provider for a large part of the North Island. And then we're also, our current tenants are asking, making noises and asking us to invest to expand. So that's really reassuring that we're getting those requests coming through the engagement from our tenants. And then lastly, drones and other technologies. Of course, I think we've all accepted drones are aviation of the future. drones and airports don't have a great relationship globally. You hear about stories of Europe. Yeah, that's the one I was going to, shut down for several days. But and aviation is very risk averse and sometimes criticised for being slow to respond. But many of you are aware we invested in a company last year called Piper Vision. They're actually a drone operator. They use a drone and they use that with a small chemical agent to help disperse fog. So for us, obviously fog in the Waikato, we do have somewhat of a reputation about that. Maybe justified, maybe not. And actually stats show we actually have less fog than Auckland. We're a net receiver of diverted flights due to fog rather than a net loser, but it doesn't have a reputation. And obviously flights we lose as revenue we lose and people that we lose from the region. So using this technology is a much more cost-effective alternative to a multi-million-dollar infrastructure upgrade for us for navigation systems and for aircraft as well. Currently, the turboprop fleet in New Zealand can't land in fog, even at Auckland, which the airport can sustain it, the aircraft can't. But Piper Vision was a chance for us to be involved at regulatory level around drone operations at commercial airports. And actually only about 10 days ago, just before Easter, Piper Vision got their first certificate, which means that they're the first operator in New Zealand can fly a drone at an airport and be treated like any other aircraft. They get a clearance from air traffic control, they operate, integrate with air traffic. So quite a milestone for us. And some of you may be aware their founder, Emily Blythe, young lady, mid-20s, has just been Kiwi Bank New Zealander of the Year in the innovation category. So really excited for the Piper Vision partnership. They've actually relocated to Hamilton Airport. They're a tenant of ours now. They can fly the drone at the airport, but they're just getting the regional council consent for the dispersal agent, which we're expecting them to be flying actively in the next couple of months.
Shout.
Someone's already controlling our drones.
Yeah.
Hi, look, I'm conscious of your time. This is the last slide. Just a quick sum up, and we have mentioned some of these, so I won't labour all of the points here. The first, Scott mentioned the solar farm, so that is under construction. We'll be one of the first airports really in New Zealand to have a solar farm. That will serve or reduce about 50% of the costs associated with the terminal, power to the terminal and the hotel. And stage 2 of that solar farm is to put some solar over the car park, which we'll do in the next 18 months to 2 years. So we're pretty excited about that. We're very much involved in this whole sustainability ESG space. We're working with Hiringa, which is a hydrogen company in New Plymouth, Waitomo Fuels, who you of course know very well, and of course, and Air New Zealand and others around alternative fuels, hydrogen, electric, what that means for infrastructure and what that means for airports going forward. So that's a big piece of work and will continue over the next few years. And you'll start to see information in the media about electric aircraft maybe flying in 2026, whether that's reasonably ambitious, but setting pre-2030, we'll be seeing aircraft flying, and you'll see much greater use of hydrogen and, as I say, alternative fuels for long haul. So that's going very, very well. The other point I would make, the company's on a bit of a journey around Te Ao Māori, and the work we're doing as part of the plan change, which is a relationship agreement as we're now terming it with NITAO, and our own sort of corporate journey in the space. So again, that's a big piece of work around our people and our culture and values that we're undertaking. And then finally, we continue to work around infrastructure. We're completing the road on the western side of the airport, the Ingram Road connection, which also connects up potable water and takes away residents on that side of the airport, both residential and commercial, that are using bore water for their potable water at the moment. So big piece in that space. As well, as you come to the airport, you'll see quite a bit of work starting to happen around the car park, and we're improving the layout of the car park, which generates and provides more car parking available to us. So that's another big piece of work. And I'll just make a couple of comments on outlook. I started by saying, we don't quite know what's ahead of us. What I would say is that we have a very certain financial performance for this financial year, because we're now almost 10 months trading into the financial year. So it'll be a very good result for the full year. So again, that helps position us for the opportunities ahead of us. Whilst there is potentially some risk there, I think we're diverse enough that we should weather it pretty well. I think that the demand for air travel is going to continue as long as we can get sufficient flights and access to flights available for people. And that's not only our port, but that's a challenge for Air New Zealand domestically and internationally at the moment. So that feels pretty strong. So all in all, I think we're in good shape. So thank you for your time.
Great. So before you run away, does anyone have any questions?
So, Mark, whereabouts is the solar farm located?
You won't see it from the road. It's actually in the gully. So if you come into the ring road, as if you were driving into the car park, it's over. Look over to your left, over behind the BP tanks, etc. And there's between two gullies. It's a slither of land, and the farm will go in there.
Cool. Liz. No, we're fine, Liz, and then Mike.
Yeah, look, I don't have a question, and yeah, look, if other people have got questions, that's great. But look, I just wanted to say, I always look forward to your reports because I'm always inspired by what you're doing. You guys are always, you never stand still. You're always looking to the future. You're looking at what the next opportunity is. And I can see here that, you're not stopping at all. So I know that COVID was a kind of a scary time initially, but you fared it very well. I always felt like we're in safe hands. So look, thanks for your report, and look forward to seeing what you come with next time.
Yeah,
thanks, Liz. Appreciate it.
Mike.
Yeah, I'll second that. You guys were great neighbours, and it's good to see this. Hey, this is probably a perennial question, but I'm a new one, so you can endure it. With your negotiations with Air New Zealand, why do I always have to drive to Auckland to fly anywhere? I would love to come to Hamilton Airport, but time after time I have to go to Auckland because the price differential is just huge. To fly on a much better aircraft out of Auckland, I just don't get it.
Well, look, interestingly enough, Mike, if we had the slide, which I don't have, on fair comparisons, ironically, it depends where you're travelling. If you're travelling to Wellington or Christchurch, out of Hamilton compared to out of Auckland, we track those every week. So we measure the fare comparatives and differentials on booking a week in advance and booking a month in advance. It's about line ball to Wellington and slightly somewhere between $50 and $70 a ticket, generally at the moment more expensive to Christchurch. So actually there is no fair differential to those cities. The challenge is when you start to fly on to Dunedin or Queenstown or Invercargill or whatever it might be. And look, we can never compete. Fundamentally, you can't compete on the fact that if you're going out of Hamilton to, say, Queenstown, you're going as far as Wellington on, say, an ATR with 68 seats versus a jet out of Auckland at 170 seats. So the ability to have lower airfares on jets is simply a factor of more seats on the one flight. And you cannot compete with that. So what we do is we try and, we work hard with Air New Zealand around trying to make sure that some of those connecting flights are as affordable as possible. But yeah. And look, the other factor is we are close to Auckland, so you've got a choice. If you were in further afield, then you might think differently. If you're in Tauranga, or if you're in Palmerston North, or if you're in Hawke's Bay, then the fare comparative is quite a different story, because you're taking an ATR from Napier to Auckland. No, to get to Queenstown. No, you're going to take it from Napier to Wellington or Christchurch to Queenstown. So we're at a bit of a disadvantage geographically. But Scott's my pilot in his private life, so I don't know, any other comments on
I think a couple of things. We see it as a hotel owner more than an airport owner, but COVID's taught us we can book holidays at last minute, and you never think of booking a holiday more than a month, less than a month out. Well, people have got into this habit of booking last minute and not having plans in case they have to isolate. Hotels and airlines love that, because we'll know in our own lives it's cheaper to book it 2 months out than it is a month out, but people are booking a few days out now. So there are still cheap fares to be there. Then in terms of what we can influence in terms of price and our charges passed on to an airline, pick a number, maybe it's $200 ticket to Wellington. Us and the reciprocating airport together probably make up about 10% of the ticket price. So, we could cut our prices by 50% and entice airlines, but what that means to the consumer is actually very little.
Yeah, I think that's pretty well explained. And I get it. I flew to Queenstown myself not long ago, and with the expressway and the time of the flight, it was just cheaper and quicker to get to Queenstown by driving to Auckland than it was to go.
We would like our shareholders to use our airport though.
I'll bear that in mind. Hang on, but sorry, I'll come. But Mike's been waiting for quite a while to make a comment. So.
Oh, thank you through the chair. Yeah, great presentation. A couple of questions. One, I dropped some people off at Whangarei Airport the other day, and they had 1 hour free parking, which Hamilton Airport has also got. Is that something that's been uniform throughout the country? Is my first question.
No, all airport companies make their own decisions around car parking charges, and they'll base those decisions based on the knowledge they know of the profile of their users. So for us, it's a no-brainer to have an hour free parking because it's a good offer, but it wasn't material to our car parking revenue.
Right.
To entice you in for a $6 coffee instead of paying $2 for 20 minutes of parking.
Well, this is exactly, it works well with our family because it's exactly what you do. Hey, and then my next question just is, look, over the decades, there has been competitors that have tried to come in to create some competition and for whatever reason have disappeared. So are there any companies on the horizon that would like to come in? And I guess my question is not so much why they disappear, but what can the airport do to actually attract competition into the airport?
Is your question domestic travel or international? Domestic?
Yeah, domestic.
So look, at the moment, we in fact have Origin Air as a good example, who fly the Hamilton Palmerston North service. So those services are tough. So generally small regional airlines do well, particularly over water, because there's no competition from road transportation. We support Origin Air. Look, and we do this with Air New Zealand in different ways as well, but we have provided support to Origin, particularly around marketing support and some other ground handling and terminal support services. So, and we have really done that for the past 18 months to support them. So we do support them, and that has helped them to try and establish the route. And that's really our responsibility here, is to try and establish the route. In terms of other airlines, it often depends where they're geographically placed, and Sounds Air is a good example that services the lower North Island and into the South Island. But look, to the upper North Island, depends on then the aircraft type and whether or not they've got a suitable aircraft for the distances that they need to cover, or that they can actually make a route that links up. And I guess that's the benefit that Air New Zealand has, is that its routes are interconnected, and they run that hub and spoke model, which is harder for smaller regional airlines to do. But Origin do that, for argument's sake, very successfully. They're based in Nelson. Their services between Nelson, Wellington and Palmerston North are very successful for them. And in fact, they've benefited too from some of the recent cyclones. So the flood damage means they've got a service operating between Blenheim and Nelson before the road opened again, is a good example. So it is a challenge, but there are a number of them operating. Air Chatham's, there are lots of regional airlines with niche operators, but it is a difficult industry for strong profitability.
Yes, thank you.
Thanks, Roger.
Yeah, thank you. Through you, Mr. Chair. I was just going to add to the point that Mike made about the Auckland versus Hamilton, and just to remind people that the Hamilton Expressway, or the bypass has foreshortened the trip there quite considerably by 20 minutes. But you've still got 3.5 hours to get back and to get out of that airport and onto the motorway. And it's chaos. And that's something that we don't have.
Look, I agree. We often say it's made a quicker journey to the car park, inverted commas, and the car park can be the southern motorway. So, yeah, look, you're right. And I think, look, we're hopeful that with, we talked about electric aircraft, one of the challenges that we don't have a Hamilton-Auckland service was the loss of the Beech aircraft and that smaller 19-seater aircraft, and the Q300, the kind of the 50-seater aircraft are just too large for that service. Yes, that's right. Ultimately, it'll be the ATR fleet. And but the electric aircraft are well positioned in that kind of 8, 9 through to maybe 15, 19-seater aircraft. And that's where a lot of the trialling will be in the next decade. And that's an ideal, and in New Zealand are starting to talk about appropriate routes to conduct trials on. And we are certainly working as closely as we can with Air New Zealand. In fact, I have the sustainability team from Air New Zealand down presenting to our board next month. So we're working hard in that space to see if there is a sensible linkage there.
Good. Okay, Claire, we'll wrap it up with you.
Just a quick question about any chance of international flights coming to Hamilton, particularly Australia or the Pacific Islands?
Look, you can never say never, but what I would say in the 8 years that I've been out at the airport, we have had no serious inquiry on international services. And I think COVID now is another layer of complexity because the airlines are only interested really in supporting routes where they have a degree of confidence. And look, one of the challenges that as part of our investigation for this decision around the extension of the runway was the fact that if we look at just across at Australia, there is no regional city in Australia that operates international services with less than 1 million people in its catchment, and the Waikato is kind of 450,000. And we'll end up with Mike's comment about what will happen. The risk is that, and I think it happened previously, is the fact that you might have an international service out of Hamilton 3 days a week, but the fare is going to be more expensive than out of Auckland. And are you and your family going to support out of here, or are you going to drive to Auckland because it's $100 a seat cheaper out of Auckland? That would be, I think, the challenge. It sounds great, but the practicalities are challenging. And so I think it will happen one day, but I don't think it's in any way is it imminent.
Yeah. So look, thank you very much, gentlemen. Great to see the airport in such good hands. You've done a fabulous job so far from where I'm sitting. So keep up the good work.
Good, thank you very much.
Too slow. So I guess what we need to do now just is consider our letters in response to, thanks, Linda, and they are on pages.
Yeah. Hey, so just while you're finding that page reference, so just to acknowledge as well that we did have a fourth statement of intent that was on the agenda. So Civic Financial Services. And we have got a letter for Civic as well. But I guess that one is in different territory because Civic is actually not a CCO. So it is well and truly owned by councils, but it's technically not a CCO. So their SOI is kind of a voluntary thing, and they don't ever float a draft one. We only even get the final one, so that's almost more for information rather than a genuine opportunity to feedback. So just acknowledging that as well, so you've got that context.
Yeah, thanks for that, Ken. So on page 139 is the letter to RAL, the airport. I guess everyone's had a chance to read it. Does there any comments or
Only just a suggestion. dividend is again a question.
Yes.
Support that, Ken, well, put into that.
So we're all happy with that. That's good. Then page 141 is CoLab. And again, I think Ken's mentioned the measurement of outcomes and whatever. So all good. Page 143, LGFA. That one's pretty straightforward, I think. And those guys are doing a good job. And as Ken said, the last one's really just an acknowledgement, really. So, okay, we're all happy with that. Let's go to the recommendation on page 26, A through I. I'm not going to read them. Happy to move. Thank you, Claire. And a seconder. Thanks, Roger. All in favour? Contrary, no. It's carried. Thanks, Yolanda. Yep, great job. Okay, very briefly now, resolution to exclude the public. Thanks,